Thank you, Gordy, and good morning, everyone. So it's time for a few numbers. So our underlying profit of $97.1 million is an increase of 13.9% on last year, with the big driver being new sale gains, which were up 110%. Reported, or IFRS profit, which includes unrealised fair value gains on investment property, was $169.5 million, $33.1 million less than last year. The reason for this drop is that last year's first half result was boosted by changes to the independent valuation assumptions. As I explained this time last year, CBRE, who are our independent valuers, lifted our 5-year plus long-term growth rates from 2.8% to 3.4%, which is an increase of 0.6%. So when you think about it, with occupancy advances of close to $3 billion and the compound impact of this change, this contributed approximately $70 million to the unrealised valuation uplift in the first half last year. So it's important everyone realises that this was a one-off, and if you exclude this one-off change, our unrealised valuation gain has actually increased from $48 million last year to $73 million this year. The valuation gain of $73 million this half is due to 168 new units and also a 4% uplift in pricing, reflecting strong demand for our village offering. Our operating cash flows were $218 million in the half, and that's up 24.4% as we've benefited from cash collections at some very high value sites over the half. And in fact, strong cash flows have continued into the second half, and we're actually expecting approximately $50 million of settlements over the next 2 weeks. So this shows the value of those sites completing, particularly Linfield and Nellie Melba, the stages. These strong operating cash flows have allowed us to invest a record $304 million in the half in new villages and in our care offering. Investing cash flows were spent as follows: $208 million building new villages, $48 million on land with a land bank of beds and units lifting 8%, $28 million was invested in upgrading existing villages, and $20 million on a range of projects, which included continued investment in our IT infrastructure, new care hubs, and further development of My Ryman. With such a major investment during the half, our working capital debt, or bank debt, has increased to $1.2 billion. We regard this as productive debt, as we invest the bulk of it in new villages where we recycle capital and which establishes a growing tail of recurring cash flows. We have a very strong financial position, with total assets of $6.2 billion, and shareholder equity has lifted by 13.7% to $2.1 billion compared to this time last year. We continue to have very supportive banking partners. They understand our growth plans and strongly support us. Our debt to debt plus equity ratio is 37%, up by 2% from March this year. We have also increased our bank facility to $1.5 billion, and over 80% of this has tenure of over 3 or more years. In the half, our gross development margin was 27%, which is higher than our target range of 20 to 25%. This is a direct result of the Nellie Melba village in Victoria, which is a very high margin site for us. We expect our full year margin to be back within our normal range of 20 to 25%. The resale bank of gains still to come currently stands at $855 million. And these pent-up gains mean we can expect our resale earnings to keep growing, even if the housing market was flat for several years, because volumes increase as villages mature. Deferred management fees also reset to new price levels with each resale, creating a compound effect. In fact, when our current portfolio matures, we would expect annualised resale volumes of approximately 1,300 units and margin of approximately $150 million, and the deferred management fees would lift to about $135 million per year. So what this means is that we can expect our profits to lift by approximately $100 million based on what we have already built. Demand remains strong for our offering as well, with only 78 units, or 1.2% of our portfolio, available for resale at the end of September. So this represents basically 1 month's vacancies. We also have our highest ever value of pre-sales of $214 million at our new villages. And our care demand was also strong, as we averaged 97% for the half at our established villages, which is a great result. And if you put that into perspective, the aged care sector in general is averaging around 88%. So the team are doing a great job and the demand is very strong. Affordability of our units is also something we monitor very closely. Our residents in Auckland and Melbourne free up significant amounts of capital when they move into a Ryman village. In fact, property prices in Auckland would have to drop 20% before the residents stop freeing up capital, and 34% in Melbourne. We also have the largest service department portfolio in the sector, with approximately 30% of a retirement village unit portfolio being service department, which are priced even lower and are purely needs-based decisions. So what triggers our ability to grow is simple: a model of recycling capital at each village. Since listing in 1999 and raising $25 million, we have now invested $3.4 billion in our portfolio and paid out a growing dividend stream to shareholders of more than $740 million, but we've never had to raise any new capital. So finally, as David said, the outlook for the full year is an underlying profit range of $223 million to $238 million. This would be growth of between 10% and 17%. Our expectations in the full year have been impacted by the two things we told you about at our annual meeting in July. Firstly, we had the unexpected 4-month delay at Hamilton, and of course, our pay increase for nurses, which will cost us $5 million this year. We're expecting our build rate to be 800 beds and units for the year, which is about 50% up on last year. And this 800 includes 300 aged care beds and 50 apartments at Malvina Major, where we are rebuilding our Figaro apartment block. In terms of the full year 2020, we expect the build rate to lift to over 900, subject to villages receiving the necessary consents. So thank you very much, and I'll now hand back over to David. Thank you.